If you wanted to learn about technical and fundamental analysis, you click on the right video. Most people enter the market asks only one question: which stock or index they should trade or invest. But they forgot the most two important things: why to buy and when to buy. The technical and fundamental analysis can answer that. That's why in this video I'll break down technical and fundamental analysis in the simplest way possible. No confusion, no complex terms. So without wasting any time, let's get to the point. First, we'll learn about fundamental analysis. If you are a trader, you can skip this part because fundamental analysis is specially for investors. So what is fundamental analysis? Fundamental analysis is nothing but the research you do in a particular company before investing. There are three concepts in fundamental analysis. Number one is intrinsic value. Number two is ratios. And number three is balance sheet. So let's come into intrinsic value. So what is intrinsic value? Intrinsic value is what a stock should be worth based on fundamentals, not what the market is currently paying for it. Basically, intrinsic value means the true or real value of a company or stock. How to calculate it? We can use Graham's formula, Benjamin Graham's, Warren Buffett's mentor, to calculate that. Intrinsic value equals to EPS, earnings per share, into 8.5 plus 2 into expected growth rate for next 7 to 10 years. You have to calculate that based on what company or stock you choose. If the market price is less than intrinsic value, the stock is undervalued. If the market price is greater than intrinsic value, the stock is overvalued. Always remember, undervalued stock is always better than overvalued. So this is exactly intrinsic value tells us. Next is ratios. There are many ratios in fundamental analysis, but we have to learn only 4. PE ratio, PB ratio, debt to equity ratio and current ratio. So number 1 is PE ratio. This ratio shows how much investors are willing to pay for ₹1 of a company's earnings. Number 2 is PB ratio. This ratio compares a company's market price with its net assets. Number 3 is debt to equity ratio. This ratio is important because this ratio tells how much risky a company's finances are. I don't describe the ratios in details, I just tell the definition. If you wanted to know how to calculate them and some key points, make sure you watch the description. So let's come to current ratio. Current ratio measures a company's short-term financial health. So these are the 4 ratios you have to learn. Now let's come to the third concept, that is balance sheet. In a company's balance sheet, we should check company's sales, cash flow and total assets and total liabilities. Assets should go up every year and liabilities should go down. If everything is fine, we can invest in that company. So these are the concepts of fundamental analysis. If you understand them, through this process, you can analyze a company's fundamental. Now it's time to understand technical analysis. Under technical analysis, there comes price action. And under price action, we have to learn these 5 concepts: chart patterns, candlestick patterns, support resistance, indicators, and trend lines. So first of all, chart patterns and candlestick patterns. I'm going to describe both together. Market is not from 10 or 20 years ago. It's from hundreds of years ago. From then, some patterns form in the market. And whenever these patterns forms, price move in a particular direction, like the bullish flag pattern. According to technical analysis, whenever this pattern forms, price moves up. Vice versa for bearish flag patterns. Same for candlestick patterns. Here are some chart patterns and candlestick patterns. Pause the video and take a screenshot. Next is support and resistance. If price goes down and bounce back from this particular zone is called support zone. And same if price goes up and touches the zone and came down, this particular zone called resistance. Support is basically where the market takes support to go up, and resistance is the price touched and came down. According to technical analysis, if support is breakdown, if support is break, we should go for sell, and if resistance is break, we should go for buy. Number 4 is indicators. I'm not a big fan of indicators. I just only use one indicator right now. But indicators is something that indicates where market can go, like a predictor. You can take confirmations with indicators before entering in a trade, but I don't use indicators very much. But if you want a dedicated video about indicators, comment down and I'll make a video about indicators. Number 5 is Trendlines. Trendlines help us to identify trend and sometimes takes trades. So look at this trend line I mark here. So look, this trend line touched the price, touched the trend line and came down. Sometimes it wanted to break that trend line but convert into a breakout failure, and this time the same also touched the trend line and came down. But in today's market, the market opens up, gap up and sustain the whole day up from the trend line. So we can predict that the market can remain upside because the market is currently the sustains upside of trend line. So that's how trend lines help us to take trades and identify markets and identify trends. If this video helps you to understand technical and fundamental analysis, make sure you like this video and share it with your trader friends. Subscribe my channel for valuable contents about trading and self-improvement. With that being said, I will see you in the next one. Till then, stay tuned.